This is Bazaar Morning Call, broadcasting live from the CNBC TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. It's a Friday morning, thankfully, heading into the long weekend, the Christmas weekend. We're coming to you from the CNBC TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Sonia and Nigel. Guys, hi. Morning.
Hi, good morning. And all set for a very Merry Christmas. I'm all set with my, green top and my earrings, and I'm ready for the party. What about you guys?
I'm in red only because of Christmas, so it's part of the Christmas color. But I think, before we get into Christmas, I think this COVID scare has again told us that health is most important, right? So as we get into this best part of the year, I think health, just be thankful, to stay healthy, and I'll be a little bit under the weather. So just happy to be a little bit better and looking forward to enjoying the coming week.
Okay, looking forward to enjoy the coming week and the long weekend, right? I mean, it's Christmas weekend, and it's good to see that there was a one-day shakeout on Wednesday, but then the market sort of bounced back back to health.
Yeah.
So that's a good thing.
No, absolutely. And what a bounce back we've had, right? 1/3 of day before yesterday's cuts recouped in one single session. So I think we need to pick up from where we left off, that is yesterday's day. And it's been pretty good. I mean, all across, can't complain. You had the market, which bounced very nicely, very, very strongly. And we finally ended and posted a positive daily close. So that's point number one, right? It would have been a bit of a bummer if the market after day before yesterday's 300-point day-to-day fall ended flattish or slightly lower, but there was a resurgence. Late rally in the Nifty Bank. Nifty Bank for most of the day was middling. It was not doing very much, but it picked up pace. Solid rally in mid-caps and small caps, both indices. I mean, actually, the 230 effect came into full force yesterday. The rally started across the board at about 215, 220 or so, but it showed through all the way in the last hour or so. And by the way, just one more thing. If you believe the leader is leader of this bull market is the PSU bank space or the PSE space, it doesn't matter banks, but public sector enterprises, that came back very strongly with a 2% rally as well. Just one point, FIIs, I just looked at positioning. FIIs are now long, net long, almost 90,000 contracts in index futures. This is as of yesterday's close. It's just a question mark. Are we at one extreme now, right? The reason I'm asking that question is because in July, if you look at when the Nifty topped, FI long positioning had reached about 1 lakh crore. You can go back and you can find similarities between 90, 1 lakh crore, around there. The market starts to top out a little bit. So I think keep one eye on this particular number as we go forward. And by the way, at the same time, when you talk about FIs, client positioning is extremely negative. When I say client, I mean non-institutional. It largely comprises of HNIs. HNIs at retail, but largely HNIs, I would assume. So it's kind of divergent at this point in time. Now, just rewinding back to yesterday, U.S. markets had bounced. Again, U.S. market had sold off the day before yesterday. The same time yesterday, we were talking about how U.S. had sold off rapidly. But so there was a bounce, 1.25% of the S&P and the Nasdaq. The 10-year is up 4 basis points, 3.8, 3.9%, but under 4. The dollar index is below 102 levels. So this is all good, no problems. We had, by the way, U.S. jobless claims number which came through, which kind of showed that the economy is doing fine. It did not show any pickup in layoffs in corporate America, in the U.S. So this is, again, something, we've had so much pushback from the time that Fed Chair Powell said that rate cuts are coming into view. So many others, at least 5 Fed governors have come in and said, well, no, let's wait it out. It's not, maybe market is getting ahead of itself, et cetera, and maybe it's for good measure because, data over the last 2 or 3 days has been pretty good. All right, let's just circle back and round it off with levels here. We put this up yesterday as well. Resistance is the retracement. The retracement from day before yesterday's high to yesterday's low. That's 21,360 on the Nifty. We're not very far away. That's a 61.8% retracement of the fall. So that's the first level that the market needs to take off. And of course, then the recent high, which is 21,593. And yesterday's low of 20,976 becomes important to defend if the market starts to sell off a little bit. But now we've put some distance between yesterday's low and where we ended. And the Nifty Bank, for it, the 61.8% retracement, we put this level out at 230 yesterday. And because the last hour rally came through, the Bank Nifty closed above this level. That is the 61.8% retracement. And now for the Nifty Bank, it is the high that we saw, which is 48,219. So fingers crossed, but hopefully that day before yesterday's crack just was like a one-day wonder thing, and we are past it. It's a long weekend, and activity, etc., will keep thinning out as we approach the next week and the week after, etc. But GIFT Nifty is showing a decent 30-odd point uptick right to the word go. Sonia.
Absolutely. So, the big question, right, that we're asking, was the sell-off on Wednesday just a one-day shakeout? And if it was, then it's a good thing, because the bulls will then use this as an opportunity to buy into the market. We almost recovered 1/3 of what we lost on Wednesday. So yeah, there was a big recovery in trade yesterday. The Nifty was back above the 21,200 mark, and just goes to show that this continues to be a buy on dips market through and through. A couple of spaces that I'm watching out for. PSU banks saw the dips getting bought yesterday. In fact, the Nifty PSE index gained over 1% yesterday, and this has clearly been the stock of the space to be in the last 6 months. So keep an eye out on that. The positive bias towards large caps is something that could continue. Remember, that's been the narrative so far, that be a little wary of mid caps, but large caps could continue to see buying action despite the volatility. The US markets were very strong overnight, no problems at all over there. The Dow was up 300 points. I'm also watching out now for commodities, both gold as well as silver. There's a lot of chatter on silver ETFs and how that's now gaining traction as an investment opportunity. And gold also gained overnight after, the data that came out from the US gave rise to expectations of Fed rate cuts in the month of March itself. So, that's perhaps the next thing to watch out for. Just a couple of things. We talk about the strong data in the US, but also keep in mind that some pockets of consumption are slowing down. For example, the Nike stock was down 10% yesterday. The company cut its sales outlook and came out with a $2 billion cost-cutting program. So all is not hunky-dory. You have to keep that in mind. There are definitely some risks on the horizon in terms of consumption and growth. But otherwise, this doesn't look like such a bad showing. And you know what? There's a long weekend coming up. So I don't think there's going to be any major directional trade being taken, but the uptrend is intact.
Well, Sonia, actually from a bullish perspective, yesterday was a better start than today, because yesterday you got that dip to get into. Yeah. And we had hinted out here that 20,950, if it holds out, then we could see a bit of a bounce. And that's precisely the way, it played out yesterday. So that was pretty good going as well. Now the bulls will be hoping for an encore. A follow-through session is what they'll be looking forward to. Nifty range on the downside, 20,950. We bounced closer to those levels. We bound off those levels. And the recent high, 21,500, we have gone to those levels numerous times in the last 1 week or so, but we haven't been able to decisively conquer that. So that's what I'm looking at on the upside. Overnight cues, well, they're positive, with the dollar as well as crude prices quite weak. Well, yesterday we saw a bit of short covering as well that did play out, because both on the Nifty and the Nifty Bank, the open interest was low, and both those two indices ended well in the green. The FIs, well, they covered more shorts than longs as well yesterday. So the short positions were covered to the tune of close to 7,500 contracts, which brings us to their net long positions. Now, the net long positions have hit 90,000 contracts. In percentage terms, it's at around 67%. The last time it was at 90,000 contracts was in July. When we hit that 90,000 contracts approximately, the Nifty level was around 19,980 approximately. From there, in the next 30 sessions or so, we corrected close to around 700 points till we became net short. And that's when the Nifty bottomed out. So the point I'm trying to make is, when the FIs go to extremes on either side, we have seen the markets either consolidate or change direction. So let's see how it plays out this time. But as we speak, FI long positioning is at around 90,000 contracts. Normally towards 100,000 odd is when you see a big swing, either on the short or the long side. Moving to the options data, the 21,000 put, well, that was fairly active in trade. 21,500 call as well was fairly active. And some will be hoping that maybe we see 22,000. So take a bit of a punt, go out there and buy the 22,000 call and hope that 7 rupees at most you lose. And if you make money, then in fact, you'll make a lot of money. But that's unlikely to happen, because volumes are as well are likely to thin out. What's the range then? 20,950, 21,500 on the upside. And on the Nifty Bank, that's going to be crucial. Yesterday, it defended that 47,000 odd mark that we were talking about. So that becomes a border on the downside. But the 48,000 call, that has the highest open interest. The premium out there is around 400 rupees, but on average, it was around 250 rupees. So 48,250 becomes a bit of a resistance zone. GIFT Nifty suggesting some green to kickstart trade. We'll need to see some follow through from there. But Sonia, you're also talking about gold. And since you mentioned that, today's the last day with regard to the sovereign gold bond. And personally, I am hedging my position as well a little bit with regard, keeping my SIPs going for sure. There's no stopping out there. But I have applied out there as well. So some kind of allocation to gold may not be such a bad thing. And you're playing the weaker dollar as well. So that's my rationale. And for the next 8 years, I believe it will give me decent returns.
Oh, absolutely. And it's a much, much better option than, a physical gold in terms of safety, etc., taxation as well. Sovereign gold bonds, great way to invest your money for the long term, of course. But on the equities front, let's take a look at what we should be doing this morning. We have some cues coming in. Chris Wood of Jefferies says that from a market standpoint, the Fed switch is clearly first and foremost the US dollar bearish and therefore positive for emerging market equities. It also, he adds, from a US and developed stock market standpoint, should be more bullish for cyclical equities relative to growth equities. He says, and despite the Treasury bond market's further rally following the Fed meeting, it is long-term bearish for the Treasury bonds, which Greed and Fear continues to believe are in a structural bear market.
Okay, well, so money market views now. This is in the rupee. Lakshmanan, a Federal Bank, says that following the 3-month high made by rupee earlier this week, it has declined since then, while most of its peers remain range-bound against the USD. The 10-year in the US, the yield and dollar index trading around 4-month lows as the silver lining for the rupee, and thus he expects the currency here to trade between 82.9 to 83.38 for the next few trading sessions.
All right, and on the bonds, Lakshmanan says domestic bonds rallied to 7.15%, which was last seen in September. Bonds are tracking lower inflation expectations and falling US Treasury rates. He expects the 10-year benchmark bond yield to trade in a range of 7.1 to 7.25% in the coming sessions.
Well, there are a lot of stocks to track for you in our special top 10 segment. We get to that in just a bit. We're looking at a few stocks, though, so let's run you through the list. We're looking at Siemens, All Cargo Logistics, we have All Cargo Gati, GMR Airports, WPIL, Ami Organics, LIC, Brigade, and RealTel. All of them will be reacting to positive news flow, while SBI Cards will be reacting to negative news flow.